Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories within financial reports. And today we're diving deep into Reitar Logtech Holdings Limited's latest annual report, a company that's been quietly building its presence in the logistics sector. Let's get straight to it. Reitar Logtech Holdings Limited, a logistics solutions provider, has released its annual report for the fiscal year ending March 31, 2025. What's really standing out is their impressive revenue growth despite a significant drop in profitability. We're going to break down what's really going on under the hood. Before we dive in, if you appreciate us cutting through the jargon to bring you the real story behind these filings, make sure you're subscribed. We also have a Discord community linked in the description below where we discuss these insights further, so join us there. So starting with the top line, Reitar Logtech saw a massive jump in revenue, going from about 252 million Hong Kong dollars in fiscal year 2024 to a whopping 378 million in fiscal year 2025. That's a 50% increase, which is pretty significant. This growth seems to be driven by both their construction and engineering services and their asset management and consulting services. They mentioned serving more clients and projects and a larger total contract amount compared to the previous year, painting a picture of a growing business. But here's where things get a bit more interesting. While revenue soared, their gross profit actually went down by about 6% from roughly 64 million Hong Kong dollars to 60 million Hong Kong dollars. Even more stark is their gross profit margin, which tumbled from 25.4% in 2024 to just 15.9% in 2025. This means for every dollar of revenue they brought in, significantly less was left after accounting for the direct costs of delivering their services. The report points to increased subcontracting costs and materials costs as the main reasons for this squeeze. Think of it like this: if a company sells a product for under $100 and it used to cost them $75 of revenue, they brought in $5 profit. Now with higher costs, that same 124 to just 15.9% in 25 to just 15.9% in 2025. This means for every dollar of revenue they brought in, significantly less was left after accounting for the direct costs of delivering their services. The report points to increased subcontracting costs and materials costs, as that's a big hit to their core profitability. Diving into expenses, operating expenses also saw a notable increase, particularly the provision for expected credit losses, which jumped from 7 million Hong Kong dollars in 2024 to nearly 17 million in 2025. This suggests they're setting aside a much larger amount to cover potential defaults from their customers on payments owed. As their business grows and they take on more clients, it seems like they're also facing a higher risk of not getting paid, or at least that's what this accounting entry is telling us. This is a key indicator of potential financial strain, or at least a more cautious approach to who they're doing business with. The consequence of these factors is a dramatic drop in profitability. Net income fell by a massive 87.8% from about 19.6 million Hong Kong dollars in 2024 to just 2.4 million Hong Kong dollars in 2025. Their net income margin shrunk from almost 8% to less than 1%. This is a really important warning sign. Even though they're selling more, they're making far less money from it. It raises questions about their pricing strategies, their cost management, and the overall health of their customer relationships. Looking at cash flow, things also took a turn for the worse. For the year ending March 31, 2025, they used HK 62.4 million in cash from operating activities. This is a significant outflow, and it's largely due to a big increase in their contract assets, which basically means they've done work but haven't been paid yet, so that money is tied up. They're also seeing increases in receivables and prepaid expenses, suggesting more money is being tied up in the business rather than flowing back in as cash. This can put a strain on their ability to fund operations and future growth without external financing. On the financing side, they did raise a substantial amount through their initial public offering, bringing in about 67 million Hong Kong dollars. This, along with increased bank borrowings, helped them manage their cash situation. But the fact that they needed to raise so much capital while also seeing such a sharp decline in profitability is something to watch closely. The company is also making strategic investments like their 3% equity in Blazemaster International Limited, which is recognized as an investment in an equity security. These kinds of investments can be smart, aiming to expand their reach or capabilities, but they also tie up capital and don't always pay off. They also acquired some smaller companies like Alvin Design and WLN, which resulted in goodwill on their books. However, the goodwill from Alvin Design was fully impaired, meaning the company recognized a loss because the acquired business brought in less value than they initially paid for it. In layman's terms, they overpaid. This highlights potential issues in their acquisition strategy, or their ability to integrate and make acquired businesses successful. Now, looking at these numbers, Reitar Logtech is definitely a company in a growth phase, but it's a growth that's coming at a significant cost to their profitability. While revenue growth is positive, the shrinking margins and negative cash flow from operations are serious concerns. It suggests that their current business model might be struggling to scale profitably, or they're taking on projects that are less lucrative than before. The large increase in provisions for expected credit losses is a particular red flag, indicating either tougher economic conditions for their clients or increased risks in their customer base. The company's direction seems to be towards expanding its services and integrating technology, even looking into digital assets and blockchain. These are forward-looking strategies, but they need to fix the core profitability issues first. The goodwill impairment on a recent acquisition is a strong signal that their expansion strategy might be facing challenges. In conclusion, Reitar Logtech is growing its top line, but is sacrificing profitability to do so. The increased credit risk and negative operating cash flow are areas that demand immediate attention. Investors should be cautious and closely monitor how they manage these challenges in the coming year. What's your take on Reitar Logtech's performance and its aggressive growth strategy despite shrinking profits? Let us know your thoughts in the comments. If you found this breakdown helpful, please like this video and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community. The link is in the description below. Thanks for watching. See you next time.